China just shocked markets with plans to cut both reserve requirement ratio and interest rates for banks. A massive liquidity shift that got traders in the US and Japan on high alert. What exactly is China trying to pull off, and why could US banks and the Bank of Japan be in for turbulence in the weeks ahead? China RRR central bank just pulled the pin on a grenade, the RRR cut, and the blast radius is already hitting Washington and Tokyo like a shockwave. But instead of showing you the debris, the media is selling you bedtime stories. They want you drowsy, they want you sedated, they want you to think this move is routine, adjustment, policy fine-tuning. No, this is not fine-tuning. This is not calibration. This is not a tweak. This is a mechanical detonation in the global liquidity pipes. And the only reason you're not hearing sirens is because the networks have muted them. Let me say it again. This is not normal. This is not cyclical. This is not seasonal. This is a last resort lever that only gets pulled when a central bank is looking at an internal rupture so big, so systemic, that the only way to keep the machine from seizing is to flood it with emergency fuel. You don't cut RRR because everything is great. You cut it because something behind the curtain is burning. And here's where the story gets darker. This isn't just about China. This is about the US and Japan panicking in real time because they know what this signals. They know what this exposes. They know what chain reaction this sets off in the global liquidity hierarchy. And they can stop it. They can slow it, they can paper it over, they can distract you with payroll numbers and CPI illusions, but they cannot stop the underlying mechanical truth. The pipes are cracking. The arbitrage engines are seizing. The shadow books are screaming. And if you're thinking, oh, maybe this is just a China thing, no. The shock hits New York and Tokyo instantly. Banks do not wait for press conferences. Algorithms do not wait for op-eds. This is algorithmic V-shock territory, where liquidity bots slam into reverse and fire off liquidation spirals before humans even finish their morning toast. The move was so violent, so unpredicted by the experts, that half the big bank analysts had to cancel their scheduled interviews. Not because they didn't have time, because they had nothing to say. Their scripts were useless. Their models were trash. Their assumptions died overnight. Because here's the real truth. The RRR cut is not a policy action. It's a distress signal. It's the lighthouse flashing SOS to anyone who knows how to decode it. And US banks definitely decoded it. That's why they're scrambling behind the scenes. That's why Japan's financial ministry is in emergency mode. That's why the derivatives desks are behaving like someone just dumped a body in the river. And while they scramble, the mainstream press is still spoon-feeding fantasy. Soft landing. Disinflation? Stabilization. It's all lies. It's all gaslighting. You're not watching a healthy system. You re-watching a rigged casino trying to hide the fact that the vault is empty and the security cameras just went dark. We step into the part where the gloves come off, because what you're seeing right now is not policy, not market dynamics, not economic adjustments. No, this is mechanical reality smashing into the fantasy land the mainstream media has built for you like a giant wrecking ball. And the wrecking ball doesn't just stop just because Bloomberg wants to keep the studio lighting soft and flattering. It doesn't stop just because CNBC wants another round of soft landing fairy tales. It doesn't stop because Reuters wants to pretend they're still relevant. Mechanical reality doesn't care about narratives. It cares about math. It cares about liquidity flow. It cares about stress fractures. And right now, those stress fractures are widening into tectonic breaks. Let me make this absolutely clear. A central bank does not cut the RRR in normal times, not even close. This isn't a stimulus lever pulled during expansion. This isn't a finesse move during neutral conditions. This is DEFCON territory. A pressure valve release you only hit when the pipes are rattling like they about to explode. But the mainstream media will never say that. They call it supportive easing. They call it countercyclical flexibility. They call it policy calibration. No, these are ghost signals. These are hallucinations. These are the desperate, empty words of a media machine that has been conditioned to distract you from the mechanical execution happening beneath the surface. You want mechanical reality? Here it is. China's banking system is under liquidity strain. US banks know it. Japan's banks know it. Hedge funds know it. Algorithms know it. But you, the public, you're not supposed to know it. You are supposed to be numbed with headlines saying market stabilizes and China stimulus boosts optimism. This is how gaslighting works. They drown the truth in a soup of meaningless sound bites, while the real moves happen in the shadows. Because let's talk about mechanical execution. The actual mechanism beneath the surface. When China cuts the RRR, it injects instant liquidity into the banking system. That sounds positive, right? That's what the media tells you. They say it frees up lending capacity. But here's the real meaning. It means banks were freezing up. It means interbank trust was fraying. It means risk models were blinking red. It means liquidity was evaporating. And when big banks sense that evaporation, They don't wait for press conferences. They don't wait for IMF statements. They switch to defensive mode instantly. They trigger hedges. They unwind positions. They flip algorithms. They pull collateral from weak hands. They reposition derivatives. All of this happens before a single journalist even wakes up in the morning. Then what happens? Bloomberg wakes up, sees the market chaos, and publishes the most sanitized headline possible. China cuts RRR to support growth. Support growth? That's the equivalent of seeing firefighters breaking down the door with axes and reporting residents adjusting ventilation patterns. It's delusional. It's dishonest. It's a go signal designed to keep the herd calm. Now let's talk about the U.S. response. Because when China cuts RRR, the U.S. banking system knows the shockwave is coming. They know dollar liquidity is about to tighten. They know capital flows are about to get distorted. They know the hidden arbitrage engines are about to misfire. So what happens? The Federal Reserve immediately gets emergency alerts through the plumbing, the repo markets, the swap lines, the shadow collateral channels. The alarms go off before Powell even gets out of bed. And yet, what does CNBC tell you? Markets mixed on macro developments. Mixed? Mixed? That's like describing a volcanic eruption as an interesting geological development. These networks are not reporting reality. They're reporting scripts written by advertisers, PR teams, and government comms departments. Because here is mechanical reality. When China pulls liquidity into the system using an RRR cut, it forces U.S. markets into a defensive crouch. Why? Because the global liquidity hierarchy is interconnected. If China is desperate for internal liquidity, it means external liquidity is tightening. If external liquidity tightens, the U.S. dollar strengthens. When the dollar strengthens, Japan collapses. When Japan collapses, treasury markets shudder. When treasury markets shudder, repo markets panic. When repo markets panic, the Fed does secret overnight injections that never make it to the front page. And yet Bloomberg calls this normal market variation. This is the lie machine in action. Now let's do what mainstream media refuses to do. The math. Not opinions, not feelings. Arithmetic. Because numbers don't lie, they expose. And look at the physical markets in Shanghai and Tokyo. Not the paper proxies, not the comics print. The real bids, the real asks, the metal that actually changes hands. In Shanghai, physical silver clearing north of $89 an ounce equivalent when you adjust for taxes, premiums, and conversion. In Japan, industrial grade material locking in closer to $130 when you factor in fabrication demand and delivery guarantees. And then you look at New York, 71. That is not a spread, that is a fracture. In a functioning arbitrage system, that gap cannot exist. It gets closed instantly. Traders buy the cheap market, sell the expensive one, move the metal, pocket the difference. That's how price discovery works. That's how the invisible hand is supposed to operate. Except here's the problem. The metal isn't moving. No ships, no surge in exports. No flood of bars leaving Western vaults to satisfy Eastern demand. Which means the arbitrage mechanism is broken. And when arbitrage breaks, it's because one side of the trade is fake. Paper can move instantly. Physical cannot. And the moment physical constraints appear, paper prices become fiction. That's what you're witnessing right now. The Western price is not the price of silver. It's the price of leverage. It's the price of confidence that if push comes to shove, delivery won't be requested. The Eastern price is the price of reality, of factories that need metal, of supply chains that can't run on press releases. So why hasn't the gap closed? Because the metal backing those Western contracts is either already spoken for, already leased 10 times over, or simply not there. The banks know it. The industrials know it. And now exporting nations know it. This is why China's restriction matters so much. It's not about today's volume. It's about tomorrow's availability. It's about signaling that physical supply is strategic, not optional. And once that signal is sent, the Eastern buyer stops trusting Western benchmarks. They start pricing independently. That's how empires lose control, not with explosions, but with parallel systems. Two prices for the same metal, one for paper, one for atoms. And the spread between them is the measure of distrust. The mainstream will tell you, oh, it's just local premiums. No, premiums don't triple without cause. Premiums don't stay elevated for months without resolution. Premiums are the market screaming that the quoted price is wrong. And here's the part they really don't want you to think about. If arbitrage were possible, Western banks would already be doing it. They would be buying at 71, shipping to Shanghai, and selling at 89 or 130. That's free money. Banks live for free money, so why aren't they doing it? Because they can't source the metal. Because what they have is paper. Because the moment they try to convert digits into atoms at scale, the vault doors echo. This is the trap. Western banks sold the world synthetic supply. It worked for decades because nobody challenged it. But now the East wants delivery, not exposure. And delivery is where the fraud becomes visible. You don't need conspiracy theories. You don't need secret meetings. The math is enough. A persistent, widening arbitrage gap is proof of failure. It means price is no longer clearing the market. It means the reference benchmark is broken. And when benchmarks break, systems reset. This is why you're seeing such violent mechanical execution in New York. The algorithms are trying to defend a number that no longer reflects reality. They are smashing price to discourage demand, to scare weak hands, to keep metal from leaving the system. But the East doesn't care about your screens. They care about tonnage, about delivery schedules, about inventory they can touch. So while you're being told silver is weak, industrial buyers are paying whatever it takes. While you're told there's no shortage, contracts are being rewritten with longer lead times and stricter terms. While analysts debate RSI levels, the physical market has already moved on. This is the quiet part. Arbitrage only works when trust exists. Trust that a contract represents something real. The trust is gone, and once it's gone, no amount of paper selling can bring it back. The divergence you see is not temporary, it's structural. It's the beginning of bifurcation. Two systems, two prices, two realities. One built on leverage and narrative, one built on atoms and necessity. And history is very clear about which one survives. Now ask yourself this. If you were a bank sitting on a mountain of short exposure, watching the physical market decouple, watching exporting nations restrict supply, watching industrial demand accelerate, what would you do? You wouldn't admit it. You wouldn't ring alarms. You would go into the plumbing. You would inject liquidity. You would manage optics. You would quietly reposition. And that's exactly what they did next. Now we enter the math laboratory where the lies fall apart. Because this is the part the mainstream absolutely cannot touch. They can sell you narratives all day long. They can hide behind soft language and analyst commentary. But mathematics? Mathematics does not lie. Mathematics does not care about political messaging. Mathematics does not bend for Bloomberg, kneel for CNBC, or dance for Reuters. Math is mechanical reality. And mechanical reality is where the entire system just broke. We're talking about the Shanghai-Tokyo-New York triangle, the so-called global pricing mechanism for metals, commodities, FX pairs, and collateralized debt flow. The system that OS supposed to synchronize the price of real-world assets across global markets so that arbitrage traders can keep everything in balance. But that system is not functioning anymore. The arbitrage mechanism, the backbone of global price alignment, has snapped. The mathematics prove it. The price spreads prove it. The physical flow breakage proves it, and yet the media pretends it's all fine. Let's start with the simplest comparison. Shanghai price versus New York price. Japan price versus New York price. Physical versus paper. Shanghai shows $89. Tokyo shows $130. New York shows $71. Do you understand the severity of that mismatch? That's not a premium. That's not a temporary distortion. That's not a market adjustment. That is a mechanical failure. When a physical commodity trades at $89 or $130 in Asia, but $71 in New York, the textbook expectation, the mechanical execution, is that traders buy in New York and sell in Asia, pocket the spread, and rebalance global markets. That's how arbitrage works. But it's not happening. Why? Because the physical metal isn't moving, the supply chain is not responding. The algorithmic pricing engines that should instantly exploit that spread are offline, disabled, clogged, or panic-locked by liquidity desks. You cannot have a $59 spread between Tokyo and New York and simultaneously have zero physical flow, unless something is broken, not bent, not strained, broken. The arbitrage mechanism is dead. Now, the media doesn't know what to do with this reality, so what do? They lie. They call it temporary demand fluctuations. They call it regional premiums. They call it currency adjustments. No, this is not currency adjustment. This is not demand fluctuation. This is not regional pricing variance. This is mechanical decoupling. Let me break this down like you're sitting in a trading pit. If Shanghai is at $89 and New York is at $71, the spread is $18. If Tokyo is at $130, the spread to New York is $59. In a functioning global system, the following must happen. Buy NY at $71. Ship metal, sell Tokyo at $130. Risk-free profit, $59. Or even simpler, buy NY at $71, sell Shanghai at $89. Profit, $18. But that's not happening. So ask yourself, why? Because the physical metal is not available at $71. Because the $71 price is a phantom. Because the New York market is not a market. It's a derivative casino. This is the dirty secret. New York's price is synthetic. It's not based on actual metal. It's just based on leveraged contracts stacked on top of rehypothecated inventory that may only exist on paper. Shanghai and Tokyo price actual metal. New York prices paper promises of metal. So when you see New York at $71, you're not seeing the price of the metal. You're seeing the price of a contract pretending to represent metal, a derivative of a derivative. A synthetic ghost price that only exists because the algorithm says it exists, not because the metal is actually available, Now here's where the math gets uglier. If the arbitrage engine were functioning, the spread would collapse instantly because the flow of metal would equalize the prices. But the flow isn't happening, which means the physical system has seized, which means the traders cannot execute arbitrage, which means the paper market no longer reflects the physical market, which means the global pricing mechanism is dead. Let's do the mechanical analysis. Step 1, Shanghai rises to $89. Step 2, Tokyo spikes to $130. Step 3, New York stays stuck at $71. This is impossible unless one of two things is happening. Either A, New York's derivatives market is suppressing the paper price artificially, or B, the physical metal is not available at any price, meaning the system has entered scarcity. Newsflash, it's both. Now let's break this down even deeper. Tokyo, so a $130 price indicates industrial panic. Manufacturers scrambling to secure physical supply because they don't trust the paper markets anymore. When industries panic, they don't wait for confirmation. They don't ask for permission. They don't watch CNBC for clues. They secure inventory and let accountants deal with the consequences later. On the other side, Shanghai's price reflects domestic tightening, a signal that China is hoarding physical supply. Not selling, hoarding. And that hoarding behavior is a direct consequence of the RRR cut. When liquidity is tight, you don't export strategic metals, you lock them down. But in New York, the price doesn't move. Why? Because New York doesn't care about physical. It cares about derivatives. It cares about paper. It cares about synthetic exposure. And as long as the contract sellers keep flooding the market with paper supply, the price stays artificially low. This is why banks in the US and Japan are freaking out. They see the decoupling. They see the spreads. They see the failure of arbitrage. And they know what it means. The next phase is systemic divergence, where physical markets break away permanently from the paper markets. And when that happens, it's game over. The synthetic market collapses. The derivative sellers get margin called. The vaults get emptied. The COMEX gets exposed. The pricing power shifts to Asia. The West loses control. The world enters a new commodity regime. Japan sees it coming. China sees it coming. US banks see it coming. Only the public is being kept in the dark. Now, let AS talk about Tokyo specifically, because Japan is the most fragile point in this triangle. Japan's banking system is leveraged beyond sanity levels, its bond market is artificially pinned to the floor, and its currency is being sacrificed to keep the whole house of cards standing. When the Tokyo price hits $130, that's not a signal, that's a siren. That's a distress flare saying the industrial base is out of metal. Japan cannot survive a physical shortage. Japan cannot outbid China. Japan cannot print metal. Japan cannot fix the arbitrage break. So what does Japan do? They panic. They intervene. They buy dollars. They liquidate treasuries. They crash the yen. And all of this traces back to the mathematical spread between $71 or $89 and $130. Numbers the mainstream pretends don't matter. But they matter, because these numbers prove the system has decoupled. They prove the arbitrage mechanism has failed. They prove the physical market has broken away. They prove the paper market is fiction. They prove New York is lying. This is mechanical reality versus mainstream hallucination. And mechanical reality is winning. We gear shift into the underground level of the financial system. The part nobody on TV is allowed to talk about. The part that gets you fired from Wall Street if you mention it. The part that makes compliance departments slam laptops shut. The institutional plumbing. The shadow corridors. The secret bailouts that never appear on a balance sheet and never get mentioned at press conferences. This is where the bodies are buried. And this is where the smoking guns live. Because once China pulled that RRR pin, something very specific happened behind the scenes. And the US and Japanese banking systems reacted instantly and violently. They didn't wait. They didn't debate. They didn't analyze policy shifts. They went straight to the emergency fire alarm and started pulling liquidity out of the shadows like firefighters dragging hoses through a burning building. Let's start with the repo market, the beating heart of global banking liquidity. This is where banks lend to each other overnight, swapping treasuries for cash like traders passing oxygen tanks in a submarine. When things are normal, repo is quiet, calm, predictable. When things are not normal, repo becomes a panic room full of screaming, and right after China's RRR cut, the Federal Reserve executed silent repo injections of $17 billion, then $34 billion, then more, but not disclosed publicly. Why the secrecy? Because if the public knew the Fed was pumping tens of billions into overnight liquidity just to keep banks from choking, the illusion of stability would collapse in 24 hours. So they do it quietly, labeled as routine operations, buried in small PDFs, never discussed on television. Meanwhile, banks are scrambling for collateral like starving wolves. Now, why would US banks suddenly need emergency liquidity? Because China RRR cut signal to the world that internal liquidity was imploding in Asia, which means external liquidity was about to tighten as well. And when external liquidity tightens, U.S. banks start hoarding cash and refusing to lend in the shadows. Repo freezes, derivatives become unstable, margin requirements spike. The whole system seizes. Imagine a room full of bankers, all holding guns pointed at each other, waiting for someone to blink. That's the repo market during a stress event. And blink they did, because the global banks executed what we call the blue whale flip. Let me explain this move because the media will never touch it. The blue whale flip is when major institutions, JP Morgan, HSBC, MUFG, Deutsche, Nomura, suddenly reverse their positions on metals, FX, bonds, and derivatives. They go from short to long, or long to short, not because of a change of sentiment, but because they've been forced into it by mechanical liquidity stress. This isn't a trading decision. This is survival mode. This is banks flipping their exposure because their risk models detected imminent structural failure. And when the banks flip, hedge funds follow. When hedge funds follow, algorithms follow. When algorithms follow, markets whiplash. And what does CNBC call that? Volatility due to investor uncertainty. No, not investor uncertainty. This is forced systemic repositioning triggered by liquidity fractures. This is the plumbing overflowing, and the media calling it minor water pressure adjustment. Let's go even deeper. When the Fed executed those quiet repo injections, it wasn't just to stabilize the banks. It was to stop a derivatives cascade. Because when liquidity tightens, derivatives become time bombs. Every leveraged position starts counting down. Every synthetic exposure becomes radioactive. Every bank with too many short positions suddenly finds itself staring down catastrophic losses if the market moves even slightly out of alignment. So what happens? They flip. Short becomes long. Long becomes short. Defensive becomes aggressive. Aggressive becomes panic. And this flip sends shockwaves across every market, from bonds to metals to FX to equities. And yet the mainstream tells you nothing except investors react to policy changes. Now let's talk about the smoking gun, collateral. Banks don't trust each other when liquidity is stressed. Banks don't trust counterparties. Banks don't trust synthetic assets. Banks only trust treasuries. So during stress events, every institution fights to secure U.S. treasuries as collateral, not because they want to invest, but because it's the only asset they can use to survive the liquidity squeeze. And guess what China's RRR cut triggered? A collateral shortage. Treasuries became scarce overnight. Yields whipsawed. Repo rates spiked. Swap spreads blew out. Bank desks went into emergency mode. This is why Japan panicked. Because Japan, yes, bond market, the world's most fragile market, is held together by duct tape wishful thinking, and the Bank of Japan buying its own debt like a snake eating its tail. When the U.S. collateral market tightens, Japan collapses internally. They have no liquidity buffer. They have no real collateral. They only have synthetic, self-referential, circular debt that depends on global stability to maintain the illusion of value. But when China cut the RRR, instability instantly ripped through the collateral network. Japan's banks felt the shock first. They had to scramble into dollars. This forced them to sell JGBs. Selling JGBs caused yields to spike. BOJ had to intervene. Intervention crashed the yen. Yen crash pushed U.S. yields up. U.S. yields up caused repo stress. Repo stress forced Fed injections. Fed injections signaled panic. Panic triggered blue whale flip. This is not a policy event. This is not macro news. This is not markets digesting data. This is a mechanical liquidity seizure requiring emergency intervention. And now here's the part the mainstream absolutely cannot report. Banks were within hours of collateral failure. Not days, not weeks, hours. And how do we know? Because the Fed injected liquidity during a period when they were supposed to be tightening. Central banks do not U-turn like that unless they are looking at internal modeling that says, if we don't inject now, the system breaks tonight. This is the smoking gun. The RRR cut wasn't a stimulus, it was a distress flare, and the Fed and BOJ's reaction proves it. Now let's talk about the true horror, the part nobody's ready for. When banks panic, they pull liquidity from the industrial sector first. When industrial liquidity dries up, manufacturers panic buy physical commodities. When manufacturers panic buy, physical markets explode. When physical markets explode, paper markets collapse. When paper markets collapse, derivatives detonate. When derivatives detonate, banks fail. A single RRR cut just lit the fuse, and the fuse is already burning fast. We enter the arena where the story gets ugly, industrial, and physically dangerous. This is where paper illusions meet real-world atoms, and the atoms are screaming. Because while banks and algorithms fight over derivatives in New York and Tokyo, The real crisis is happening in vaults, factories, and shipping yards. This is where industrial bombs are ticking, and physical metal is vanishing faster than anyone can track. And yes, I'm talking about silver, the war metal, the unobtainium, the asset nobody on CNBC will admit actually exists outside a contract. Let's start with the auto industry, because it's the most obvious bellwether. Samsung, for example, is racing to produce solid-state batteries for EVs. Each battery consumes roughly 1 kilogram of silver per car. Think about that. 1 kilogram. Multiply that by millions of cars and production queues. Multiply that by corporations hedging against paper shortages. Suddenly, physical demand explodes, and paper derivatives, no matter how cleverly layered, cannot satisfy it. This is mechanical stress turned industrial reality. The market cannot create atoms out of digits. No algorithm can manufacture silver, and yet the COMEX pretends everything is fine, pretends liquidity exists, pretends inventory is adequate. It's not, it's gone. And when it's gone, the true horror shows. Vaults start draining faster than reporting allows. Now look at China. They are not just cutting RRR. They are hoarding silver for strategic industrial use. Export bans, domestic stockpiling, priority allocations, all moves that tighten global physical availability. Combine this with industrial demand, and suddenly silver is no longer a financial instrument. It's war material. It's critical infrastructure. It's the strategic asset behind next-generation batteries, electronics, and energy storage, and that makes the paper price in New York laughably irrelevant. It's a hallucination, a ghost, a contract pretending it represents atoms that no longer move freely. Meanwhile, COMEX and Asahi vaults in New York and Tokyo are starting to reflect the reality of these industrial bombs. Reports indicate physical withdrawals hitting levels unseen in years. Vaults are not replenished because the global supply chain is clogged, and the arbitrage mechanism we discussed earlier has failed. You see the numbers. Paper positions balloon while physical stock collapses. That is mechanical divergence. That is what panic looks like in atoms versus digits. That is the financial Armageddon nobody is willing to speak about. Let me be crystal clear. When industrial demand hits a finite physical pool and paper derivatives remain unlimited, you create a system-wide leverage trap. The more paper that exists, the higher the premium for real metal. And when real metal cannot flow, arbitrage fails. Algorithms flip into liquidation mode. Banks trigger blue whale flips. Treasury collateral gets hoarded. Repo markets explode, and the mainstream calls it minor volatility, while you, the informed viewer, see the war map. And don't forget the domino effect. China hoarding silver, Samsung devouring it for EVs, Japan desperate for imports, US paper markets collapsing. This isn't theory. This is happening in real time. Vaults drain, industrial buyers scramble, and derivatives desks panic because the collateral backing those contracts is vanishing before their eyes. When a ton of silver exits COMEX or Asahi, the algorithms see a vacuum, and the mechanical execution of panic takes over. We are literally watching a digital to physical cascade failure. Paper contracts mean nothing. Algorithms can liquidate all they want, but they can't create metal. Physical atoms, real supply, are leaving the system, and the institutions that once controlled the market are powerless. Because here's the truth. The war metal doesn't negotiate. It doesn't blink. It doesn't obey the Fed or BOJ. It only exists where it exists. And right now, atoms are moving east while paper is screaming west. So what do you do if you are a bank? You hedge, you hoard, you panic buy, you shift positions, you trigger repo interventions, you flip short to long in a matter of hours. But that only delays the inevitable because industrial demand and physical scarcity always win over paper. Always. And this is why the mainstream media calling silver a soft asset is not just wrong. It is criminally misleading. Let me give you one more perspective. The supply-demand math in 2026 is brutal. Between EV production, industrial hoarding, and COMEX Asahi withdrawals, global physical silver turnover is at near historic lows. Yet paper derivatives have exploded in volume. That means every contract in New York is a leverage trap waiting to explode. When atoms cannot be matched to digits, the system becomes inherently unstable. One misstep, one margin call, one liquidity shortage, and the dominoes fall, and the mainstream will still call it a market adjustment. Do you see now why the RRR cut was the trigger? Not the cause, but the spark. China's liquidity move exposed mechanical weakness. It forced institutional panic. It accelerated industrial demand. And it revealed that the paper market is lying to you, a lie that can no longer be sustained. We are living in a world where physical metal is war grade, industrial bombs are real, and vault drains are more important than stock tickers. And yet your news anchor smiles and tells you markets are stable. That's the disconnect. That's the gaslighting. That's the financial Armageddon in slow motion. And now it's time to cut through the noise, stop staring at paper illusions, and get down to the survival plan. Because this is where most people fail. They see the chaos, they hear the headlines, and they assume someone else is in control. They aren't. The system is cracked, arbitrage is dead, repo plumbing is leaking. Banks are flipping positions like a game of nuclear chess. Industrial demand is draining vaults, and if you're still stuck in digits, you're about to get left behind. Here as the hard truth. 2026 is the year the shift from digits to atoms becomes unavoidable. If you are holding synthetic positions, paper contracts, ETFs, or leveraged derivatives, your exposure is a ticking time bomb. The mechanical reality is clear. Atoms win. Real, physical, tangible assets always outlast paper, always outlast leverage, and always survive systemic failure. And that is why you must act now. Let me give you the simplest rule to survive this, the 5 and 200 rule. Rule 1, the 5. Always keep at least 5 months of critical physical exposure in real assets. Metals, energy, industrial essentials, whatever survives systemic liquidity stress. This isn't speculation, this is insurance. 5 months is the minimum to ride out the next mechanical shock, the next liquidity squeeze, the next accidental collapse of a paper market. Rule 2, the 200. Maintain a buffer of 200% coverage in physical holdings compared to your paper contracts. Every digit you hold in ETFs, futures, or synthetic positions should be backed by twice the atoms you can control. Because when the arbitrage mechanism dies, your paper contracts are worthless unless matched by atoms. 2-to-1 coverage is your margin of safety. Follow these rules and you survive. Ignore them, and you're gambling in a rigged casino where the house already knows the outcome. Next, let's talk strategy. Shift from digits to atoms immediately. This means stop relying on exchanges that list paper derivatives pretending to represent metal. Secure physical assets in vaults you control, not just allocated accounts you can't touch. Diversify across geographies, east, west, wherever atoms are stored physically. Prioritize strategic metals, silver, gold, critical industrial elements. These are war metals. Their demand is structural, not speculative. And finally, you must monitor the industrial flows. Watch the EV manufacturers. Watch China's export policy. Watch comics and Asahi withdrawals. These are the mechanical signals that the mainstream will never report. These are the atoms moving while digits scream. Because here's the final inescapable truth. The next financial Armageddon is already in motion. The RRR cut was the spark. US and Japanese banks are panicking behind the scenes. Physical markets are diverging from paper. Vaults are draining. Algorithms are executing V-shocks. And if you're still in paper, you're a part of the illusion, the gaslight. So take control. Shift to atoms. Follow the 5 and 200 rule. Prepare for systemic divergence. And remember this, when the dust settles, it will not be the digit holders who survive. It will be the atom holders, the ones who understood mechanical reality, the ones who ignored CNBC, the ones who stopped trusting paper and started trusting physics. I will see you on the other side. Like, subscribe, and share.